Technology has transformed our world. With a single tap or swipe, you can pay your bill, book a room or a ride home. Technology can even read your mind. It can take you places you never thought you'd go. Technology is making life simpler, easier, and cheaper. And investing seems to be no exception. Paris, one of the biggest investment debates of our time is active investing versus passive investing. And within this debate, technology has also played a role.
Yes, so interestingly, both strategies, active investing and passive investing, have been around for a long time. I mean, passive investing has been with us since the 1950s, 1960s. But where technology has really played a part has been in lowering the cost of passive management. Things like electronic trading, market making, price transparency. That's led to this enormous rise in the number of passive strategies and index funds.
So active investors really are stock pickers and fund managers, but the attraction of passive investing is that it is cheap. And advocates of this type of investing say, why buy an active manager if few of them tend to outperform the market? What do you say to this?
When we look at sort of the performance of active managers, one of the ways in which they really deliver value to the clients is actually in preserving capital during moments of weak markets. So I think that's one of the things that I do think for investors it is worth paying up for.
We are in the second longest running bull market since World War II, and that environment really has benefited passive investors. But there's no guarantee that this will continue indefinitely.
Oh, I think you're absolutely right, because effectively, you get exposure to the market index, which is sort of rising. The fact that you're paying a lower price means that there's no sort of trade-off between that. And I think absolutely that's one of the things that's led to this rise in passive investing. But I think one of the most interesting things to note about this is that the more passive investors there are in the market, the less efficient the market becomes. It becomes less efficient because a greater number of people don't care about the value of what they're buying. So actually, not only do we see at the point where the cycle changes, the risk of there being more volatility in the market, but actually increases the opportunity for active managers in the next cycle.
Because active managers can tap into those market inefficiencies.
Absolutely. The whole premise of active management relies on identifying individual inefficiencies and benefiting from those. So if the market in general is becoming less efficient, hence you get more opportunities for active managers.
There's little doubt that technology has made passive investing easier and cheaper. But the rise of passive investing has also created opportunities for the discerning active investor. And when technology lets you down, you do need the human touch.